Hey everyone, and welcome to The Explainer. I'm super excited you're joining us today because we are diving headfirst into a massive, viral pop culture myth, and we're going to uncover some seriously hidden biology behind the stock market. We're talking enormous wealth, global superstars, and the literal neuroscience of how investors make decisions. It's a wildly fascinating ride, so let's jump right in. So I want you to think about this for a second. Can one single athlete actually wipe out $4 billion in a matter of seconds? I mean, it sounds totally absurd, right? But I want you to really consider the unbelievable financial power of just one viral moment in our hyperconnected world today. Just keep that question in the back of your mind as we go. All right, section one, the $4 billion snub. Okay, let's rewind to the summer of 2021. Picture this. It's your standard pre-match press conference for the Euro 2020 football tournament. Cristiano Ronaldo sits down at the mic. And right in front of him are two very strategically placed bottles of Coca-Cola, which is, an official sponsor of the tournament. Now, Ronaldo is notoriously strict about his diet. This is a guy who probably considers a second grape a cheat meal. He looks at the sodas, he's visibly annoyed, and he physically moves both bottles completely out of frame. Then he picks up a plain bottle of water, holds it right up to the cameras, and simply says, Agua, water. Now, to really grasp the gravity of this tiny, seemingly insignificant gesture, we have to understand this massive number. 550 million. That was Cristiano Ronaldo's social media following at the time. We are talking about a single human being with an audience larger than the entire populations of most nations. It's an immense, almost unprecedented level of personal power over global brands. When he speaks, or in this case, when he literally just moves a bottle, the whole world pays attention. And wow, almost immediately after he said Agua, the headlines absolutely exploded. The news was everywhere, reported that Coca-Cola's share price had taken a 1.6% dip. Now, 1.6% might sound like a tiny fraction, but for a corporate giant the size of Coca-Cola, that meant its market value dropped from $242 billion down to $238 billion. Bam. The media narrative was instantly locked in. Cristiano Ronaldo's snub wiped out $4 billion of Coca-Cola's value in a matter of seconds. No way, right? Well, let's move into section 2. Correlation is not causation. But hold on just a second. Let's put on our financial detective hats here, because we really need to look at what actually happened to the stock that day. In the world of finance, and honestly, just in life, correlation does not equal causation. Just because two things happen at the exact same time doesn't mean one caused the other. The timeline here is absolutely brilliant for illustrating what was really going on behind the scenes. On Friday, June 11th, the market closed with Coke shares at $56.16. Fast forward to Monday morning, June 14th. At 9:30 a.m., the U.S. market opens, and Coke shares immediately drop to $55.35. That initial drop accounted for the vast majority of that $4 billion. But here is the ultimate kicker. Ronaldo's press conference didn't even start until 9:45 a.m. The stock plummeted 44 minutes before he even walked into the room or touched those bottles. So, you're probably wondering, what actually caused the drop? Well, it was a standard financial event called going ex-dividend. All this means is that a stock is trading without the value of its next scheduled dividend payment. When a company pays out a cash dividend to its shareholders, the company's total assets decrease by that exact cash amount. Therefore, the share price just naturally adjusts downward to reflect that money leaving the corporate bank account. Plus, if you look at the data, the entire U.S. stock market was trading lower that specific morning anyway. So we really have to separate that flashy viral narrative from the actual boring financial mechanics. On one side, we've got correlation. Ronaldo says Agua, and the stock just happens to be falling that day. But on the exact opposite side, we have true causation. The stock went ex-dividend, naturally lowering the price, way before the press conference even started. So actually, scratch the whole headline. Ronaldo didn't crash Coca-Cola at all. It was literally just a massive coincidence of timing. Which brings us to section 3. The rise of athlete activism. Now, even though Ronaldo didn't actually crash the stock, the simple fact that we all believed it so easily points to a very real phenomenon happening right now. Modern athletes aren't just walking billboards anymore. They are their own independent media empires with deeply held personal values. We had Ronaldo prioritizing his strict health message over a tournament's soft drink sponsor. During that exact same tournament, Paul Pogba, who is a practicing Muslim, removed a bottle of Heineken 0.0 from his press conference because of his religious beliefs. And right around that same time, tennis superstar Naomi Osaka withdrew from the French Open specifically to protect her mental health, pushing back against outdated mandatory media obligations. The big takeaway here, Personal brands are superseding traditional tournament sponsorships. Mega corporations can no longer just dictate terms to these megastars. Okay, let's pivot to Section 4, the nicotine withdrawal anomaly. So, we just thoroughly debunked a myth where human behavior supposedly crashed a stock. But what if human biology actually does hijack investor rationality? Let me ask you a personal question. Have you ever made a genuinely bad decision just because you were super stressed? Or maybe you were trying to break a bad habit, maybe you were trying to quit drinking coffee and you ended up snapping at a coworker? Now, I want you to imagine experiencing that exact same biological stress, but you're sitting on a chaotic trading floor, actively making decisions with millions and millions of dollars. And that thought leads us directly to this mind-blowing piece of academic research. This study from Econ Store literally looked at the intersection of neuroscience and market dynamics. Specifically, the researchers zeroed in on the United Kingdom's annual No Smoking Day. If you don't know, it's this massive public health awareness campaign on the second Wednesday of March where smokers across the country are encouraged to just quit for 24 hours. The researchers asked a brilliant question. Does this sudden, nationwide attempt to quit smoking actually affect the stock performance of major tobacco companies? To understand why it possibly would, we really have to look at nicotine withdrawal syndrome, or NWS. When someone who is dependent on nicotine suddenly stops, their body aggressively reacts. It is a severe physiological response that causes nervousness, deep anxiety, lightheadedness, and a notably low mood. It literally impairs your cognitive focus and triggers significant psychological stress. It's rough. Now, what's absolutely fascinating is the data they uncovered. When looking at the stock returns for massive tobacco companies like British American Tobacco and Imperial Brands, on regular trading days, these stocks generally see steady, positive returns. But on no smoking days, the returns for these corporate giants consistently plunge. They literally go negative. So why does this matter to us? Because it means that neuroscience is actively overriding the efficient market hypothesis. In finance, this well-known hypothesis states that a perfectly rational market should already anticipate everything. A scheduled annual event like No Smoking Day shouldn't shock the system at all. I mean, it's right there on the calendar every year. The market should absolutely price it in beforehand. But it doesn't. The data strongly suggests that the actual withdrawal-induced stress and anxiety experienced by the investors who are trying to quit smoking, or maybe even just the overwhelming negative sentiment generated by the nationwide campaign, actually drives irrational, negative trading behavior specifically on that one day. Basically, biology beats the spreadsheet every time. Let's wrap things up with Section 5, Protecting Brands Today. We've looked at viral celebrity snubs, and we've looked at stressed-out investor brains. So what can companies actually learn from all this? What are the key strategies for surviving in the modern market? Well, first off, it's time to retire outdated product placements. Forcing a sugary product in front of an athlete who fundamentally disagrees with it, that's just a recipe for an immediate PR disaster. Second, companies have to respect the rise of the personal brand. They need to strategically align with individuals whose values actually match their own. Third, we all need to learn to differentiate between loud social media noise and actual fundamental market drivers. Always remember, correlation does not equal causation. And finally, brands need to recognize that hidden biological and psychological factors, like stress, withdrawal, and public sentiment, have a real, mathematically measurable impact on how people behave with their wallets and their investment portfolios. Which leaves us with this final, provocative thought to ponder. In an era where deep human biology and massive, powerful personal brands can seemingly dictate the mood of the market, what is the actual future of corporate sponsorship? How do traditional legacy companies survive when the real power has shifted so dramatically to the individual? Thank you so much for joining me for this explainer. I really hope this empowers you to always look past those flashy viral headlines, to critically question the narrative, and to remember that sometimes the absolute biggest market forces out there are simply human nature. See you next time.